Well, hello there. This is Bruce at Fleet Capital Management. It's Friday afternoon, the 27th day of December, 2024. Only a few more days left. I hope you had a wonderful Christmas, Hanukkah, Kwanzaa, whatever it is that you may celebrate. I hope you had a very nice time, and hopefully you were with family. We're going to take a look at the market. You've got to remember that between Christmas or just before Christmas and just after New Year's is kind of a dead time in the market. And I'm going to come back to that. So put a pin in that so that you can understand what happened in the market. We'll get to that in just a second. We always start by saying the video presentation is intended for educational purposes only. The discussion of any security is not a recommendation to purchase or sell the security. You know that I am always available, Bruce at fleetcapitalmanagement.com. If you have any questions, concerns, comments, anything, reach out to me. I'd love to hear them. I had someone that I was talking with the other day say, well, this time it's different. We got Trump back in the White House and tariffs and all of those things, and it's very different this time. You may remember Sir John Templeton from the Templeton Funds. He was one of the, I would say, the grandfathers of the whole industry. And he very famously said the four most dangerous words in investing are, this time it's different. And I'm going to explain to you why it's never different. And we'll come to that in a second. But a little more on Mr. Templeton. He was a renowned investor and philanthropist who believed in disciplined investing and avoiding irrational exuberance. He also said the market is always born in despair, grows in doubt, matures in longing, and perishes in hope. He believed, as does Warren Buffett, that the most pessimistic times, when people are the most pessimistic, are the absolute best times to buy. And when everyone is optimistic, best time to sell. And man, is that true. So when I hear this time is different and tariffs and Trump and blah, 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 all the noise, that's good. That means that there is despair, maybe doubt in the market, and that's what we like to see. What we don't like to see is overly optimistic. Well, it's easy to make money. Then you know the market's dead. It's going to turn. It's going to take it right away from you. So this is really, really important. And he talks about being disciplined. And I want you to know that I'm very disciplined. Our trading systems are very disciplined. Our trading systems are broken down into four very general categories. When to buy, those are the market timing systems. What to buy, both fundamental and technical analysis. When to sell, that's really stop management. And if earnings are coming up, do we hold? Do we sell? Do we put a tight stop? What do we do around earnings? So let's come up here. I want to talk about this for a second. Market timing systems. There are many, 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 many millions of people out there who say you can't time the market. And my response would be, maybe you can't out of ignorance, but yes, market timing is possible. And I'm going to show you how we do it time and time again. And it was only in this last year after the bear market that we really honed in on our market timing systems to the degree that we'll never participate in a bear market again. Never. Unless for like group one, the most aggressive, we are using certain types of instruments that profit as the market falls. That we will do. Group one will automatically get those. Group two will be asked if they want to participate in those. That's a difference in the groups. So timing, and I'm going to show you how we can time both the market and individual securities. The most important thing to know, step one, is the market going up or down? Everything follows from there. So let's go to our matrix. This is updated through today, only 4 days in this week, of course, because of the holiday. We always base it on the S&P 500. Doesn't mean we don't look at the NASDAQ. We do every day, but it would get too cluttered if I showed you everything. So this is the daily and this is the weekly, these two. And on the daily, it's broken up also into two columns. This first column is based on volume and momentum. And the second column, the D is daily, is based on indicators, the 3 moving average and the 21 moving average. And if the 3 is above the 21, it's up, it's green. If the 3 is below the 21, it's red. And over here, volume and momentum. Remember what I've taught you and mentioned many times. There are hundreds of different indicators out in the marketplace, but there's only two that are considered leading indicators that somewhat tell you what's about to happen very quickly, and that is volume and momentum. And this just stands for moving average convergence divergence, which is a momentum indicator. So if one is up and one is down, it's mixed. If they're both down, it's red. If they're both up, it's green. That's how you read it. Very simple. And we've had some red, and we've definitely had for a couple of weeks now. We've had red and yellow. So on the short term basis, it hasn't been much fun, to tell you the truth, December. On the weekly, we've been all green except for we just went into mixed, but it's so close, and I'll show you on the chart. That'll probably pop back up. Here's our daily moving average stack, we call it. To be in a perfectly bullish technical analysis setup, the 3 moving average is above the 20 is above the 50 is above the 200. That's when it's green, okay? When the 20 goes above the 3, that's just a pullback. And pullbacks happen numerous times throughout the year, numerous times. That's just very normal, and then they pop back. But what it is it's a very early indication that weakening may be starting and may be persistent. Because if it continues and the 20 falls below the 50, then we're in a correction, and it would be this color. That's the 20 less than the 50. And corrections happen, well, I would say 3 times a year, usually, maybe 4, but usually about 3 times a year, not as often. They're tough to go through. We get stopped out of a lot of things. And then, of course, if the 50 is below the 200, that's a bear market. But we use a different bear market avoidance indicator that we created based on the weeklies, and that's the 10-week over the 20-week EMA, or exponential moving average. And it's either up or it's down. And if it's red, we're in a bear market. If it's green, we're not in a bear market, no matter what anything else says over here. And then we have the fear index, which is the VIX, and that also can help us time the market. When 17 and below is what we call the sweet spot. 17 to 20 is, we need to be a little bit cautious in here, and it did get up into that area here. Above 20, which it had 2 days, generally means the market's going to fall because there's a lot of fear in the market. And when there's fear in the market, usually prices drop. So we've had in the market a pretty bad couple of weeks or week. Did we see it coming? Yes, because of our market timing signals. We absolutely saw it coming. I have a whole fistful of stocks that are fantastic stocks that I want to buy for you, but not when it's red. This helps us avoid that. If the weekly goes red, we definitely aren't buying anything, and now we're looking at potential trouble. And we're looking over at this side to see if this is heading into a severe correction or bear market. But right now, it's kind of green, and there's a lot of mixed on here. So let me go to the charts and let me show you some things. Let me find my charts. Here we go. So here's the S&P 500. Daily bars, each bar is 1 day, it's on the left. Weekly is on the right. I'm going to spend a little bit more time on weekly today because I want to help you understand something here. But you can see that, let's see, what date is this? That was December 5th. Right here is December 5th. And you can see the market's been down. It popped up, it went down. We're not even close to where, we are close, but we're not even as high as we were on December 5th or December 4th. So it's been a rough couple of weeks. And this is why I don't buy you stocks, because I don't know if this is going to stop here. No one does. But our indicators said that there was trouble on the horizon, at least short term. Dailies are short term. Weeklies are much longer term, not just the difference in 5 days. So we saw this coming. And when this clicks back and starts to get almost all green or all green, we're going to start buying stocks. And that's how we time the market. And it works. Okay, so you can see we had some yellow and red in here, and the markets fell. Let me just turn that alarm off. And so that's what it is. here's that white is the 3 moving average. It came way down. It crossed below the 20 right there, the blue. And that's was a cause for, actually, that was a cause for this to be down when the 3 is below the 20. And then you can see this is one of our volume indicators. This is on balance volume. It's still green, but man, it's close to not being green. And here's our momentum, which is getting better, but it's still red. And that's why it was mixed. Okay? That's all that means. Let's go over to the weekly. And before I talk to you about the weekly, what I want you to notice is, and you might need to just lean back, you see how nice and orderly this row of candles is, much less jagged than the dailies. You see that? You see how jagged and how much, we call that noise, how much noise is in the dailies. This is the same thing as the S&P, but each bar is a week. So what I want you to understand is there's a lot of noise that happens from day to day. It's very, very, very common. That's why I go over to the weeklies to see how they look. So with all of this noise, the white is a 2-week moving average, is still above the 10-week moving average, which is above the 20-week. And the red, the green, I beg your pardon, the blue and the gold mustard colored, that is, that's our bear market avoidance set right there. The white is one of my trading indicators. So yeah, we've had a couple of pullbacks, but in most part, we're up. And it's very bullish. Everything is bullish over there. Not everything is bullish here. A lot is, but not everything. And that's why it has some mixed signals. So I want you to understand that when I am looking at the market or at an individual stock, the first thing I look at is the weekly. Because like right now, if we come down here, that little red, this is the momentum indicator down here on the weekly. It just went red. But the on balance volume, I wish those pop-ups would stop. On the on balance volume is still green and looks like it's turning back up. So this very easily over the next week could pop back up and we'd have a green situation on there. This indicator I have not taught you about, so don't worry about that one yet. So the bottom line is I always look at how's the market on a weekly basis first. And I do have a little bit of a warning sign, which is that the MACD or the momentum has turned red. That needs to turn green before we start buying a lot of stocks. That's just one of the rules. Now, let's say that was green. Then we go to the daily and we look at all of our indicators on the daily and see if they correspond with what we're seeing on the weekly. If the weekly is all green and the daily is not, we're still going to probably wait. We're going to wait until things turn around. I want that 3 moving average back on top of that 20 moving average. And it's not very far. One good day will do it. I want this OBV, which is volume, to stay green and turn back up. I want this momentum indicator to get back up to green. So what I'm telling you is we look at weekly first because we can see a bigger picture on the weeklies. And then we look at the dailies. Now, that's how we time the market. Let's talk about some individual securities. We were in XLF, which is a financial sector ETF. I think we bought it somewhere around here. It went up and went down and went way up, and we sold it. We got stopped out somewhere around here, and it has fallen dramatically. And I can even show you if I go to one of my portfolio trackers. This is for my ETFs. There's XLF right there. It's closed. We're not in it any longer. We went into it on October 7th. You can see the buy, and we sold it on December 10th. So we had it for just about, let's call it 2 months. And we netted almost 9%, 8.79% in 2 months. Not a bad rate of return. How did we do that? We timed it. And one of the ways that we timed it, going back here, was here's sector seasonality. We knew that the financials do well in this time frame, so we went in when the chart looked good. That's how we did it. And going back to the chart, I hope this makes sense, and this is the XLF. When I went in it, everything was looking good. Yeah, it can change after that, but everything was looking good. And then we had a fairly tight stop. We got stopped out somewhere right around here, and it kept falling. So I was very happy we were stopped out. Will we go back into XLF? Absolutely. We're still in that time frame where financials, time frame of the year, where financials tend to do well. So the first thing that has to happen is that white line needs to cross back up. That's the 2 week needs to cross up above the 10 week. That is a must. We still have good on balance volume. We had just a skosh of negative not moving average, excuse me, negative momentum. So when all of that gets cleaned up, then we'll jump over to the daily side. I want that 3-day moving average on top of this 20. I want on balance volume to turn back up green. I want our momentum to come back up above the 0 line. And I want to see some volume kick in. We're in very low volume time right now. So let me just show you one more example of how we time, because people always say that you can't time, and I don't understand that. Here's Bitto. This is for my Bitcoin folks that trade with me on Bitcoin. This is before the new symbol, but this is the older one, Bitto. And we were in it, and we got stopped out, and we made 23.71%. Great. And then we went right into IBIT, which is also Bitcoin ETF, and we made another 33.82% on top of the 23.71%. How did we do that? Well, it's not a mystery. Here is Bitcoin. We were riding it up, and I put a stop. I happen to still have it on the chart right there. We had a stop, and I had a lot of reasons why I put it there. We got stopped out. We took our profit, and it continued up. And that happens sometimes. And I started to get a couple of emails right in here, people saying, don't you want to get back into Bitcoin? And I said, no, because the chart is telling me not to. Here's our momentum was falling. And there were other reasons. But I said, no, not yet. But on the weekly, we're still positive momentum, positive volume. We're still good with our moving averages. So now all I'm waiting for is I want to see that 3-day white moving average cross above the blue 20-day moving average. I want this on balance volume to go back into the green, and I want momentum to come back right above that 0 line. And I want it to happen with better than average volume. Volume is key. You see how powerful this rise was? Each one of these is a week. See how powerful that was? Look how big these volume bars were over their average, which is that green shaded. See that? So volume is really the kicker that we need. And then we'll go back into IBIT again and probably make a nice amount of money. We did the same thing with NVIDIA. Let's see. NVIDIA, we've been in a couple of times. We've made an enormous amount of profit in NVIDIA, and it just doesn't look great yet. It's, the momentum is down on the weekly, the moving averages aren't right. That's fine. I don't care how long it takes. We might be out of NVIDIA. You could almost see that this is a huge sideways action, if you would. It's pretty wide, but a consolidation period. And I want to see a consolidation period on the weeklies as well. I don't care how long it consolidates. The longer it consolidates, generally speaking, the bigger the move, whether it's up or down. This is a consolidation. Those are dash lines. Those are consolidation lines. And what we don't know during the consolidation is it going to break to the upside or break to the downside? We don't know until we see it. And we can anticipate based on what's happening on the chart. But yeah, so I don't mind how long we're out of it. I'm very patient. Bitcoin's probably down 15% from where we got out. Aren't you glad we're out? We'll go back in and we'll make that money. So I know I've just run through a lot of stuff, but I hope this makes sense. Number one, you can time the market. Number two, you can time securities. Are you right every time? No. That doesn't happen. But if you're right more than you're wrong, if your gains are larger than your losses, you're going to be profitable and you're going to do just fine. So that's kind of what I wanted to cover. I have a lot of screeners that I use that I've created. I have three or four in this one. I've got one screener in this one. I've got another new screener in this one. So there are a lot of screeners that I use. And what those screeners do is we're going to assume the market looks good, which it doesn't yet, but it will. Then the screeners every night might give me 15 or 20 stocks that have passed all of my criteria for quality and everything else. I take those, I put them into this charting platform, and I go through each one of them to see, does this look like something I want to buy? Am I buying it at a good time? To give you a very quick example, because I know I've run a little bit long, let me go down to, let's just go down to here. AMD is the first one. Okay, would I buy AMD right now? No. The technicals look absolutely terrible. Chewy. Would I buy Chewy right now? That looks kind of interesting. And it has a little highlight, which I put because that does look interesting. KNSL, would I buy this? Nah, it looks pretty lousy. So this is how fast I can go through. Would I buy this? Nope, don't like how it's looking. And sometimes it's overextended. This one's not, but sometimes I'll bet Tesla is. Let's look. Tesla is right at the top of its linear regression. It had this huge parabolic run. I wouldn't buy that yet. I want to see it come back and then buy it. It's a little bit too rich right this minute. So I go through about 15 to 20 stocks a day and take a look, and they've all passed my criteria. Take a look, and that's how we buy them. Then we do stop management. Then we go into the next phase. So I'm out of breath. I've run through a lot of stuff. I hope this helps a little. I'm going to start leaving my charts like this so you can see the weekly more clearly and the daily, because so many times the daily has so much noise on it that you don't know if it's an uptrend or a downtrend or what's happening, how much risk. But with the weekly, you can get a much cleaner view of what's really going on in the markets. Okay. So I hope that helps. I hope that answers some questions. Um, Now, the last thing, why did the market fall so hard today? Between Christmas and New Year's, there's very, very little volume. Very little volume. Lots of people just take the 2 weeks off. To push prices up takes a lot of energy. A lot of people have to be pushing prices higher. They have to, a lot of buy orders. When those people aren't there, prices can very easily drop. It takes one or two sellers to drop prices. So that's why we're seeing these big swings. I mean, the market was off pretty solid today. That's why. It's because there are not a lot of buyers present in the market, and there were a few sellers, and they got their way. But next week's probably going to be somewhat similar to this one, and then we'll cross over into the new year. And I expect, it's possible that the first week could have some selling because people have a lot of profits and they push their sells into early January. So then they don't have to pay taxes for another, what is that, 15, 16 months. That could happen, but I think the market looks fine. I'm not worried about Trump. I'm not worried about the tariffs. Are they going to cause havoc? Yes. But if it's not them, it's something else. There's always stuff going on in the news and politics and geopolitical arguments. There's always stuff. We're going to use these same systems no matter who's in office, no matter what's going on in the world. It will tell us when we should not be buying securities. It will also tell us when we should be in cash because there's some real bad things happening. But it will tell us because everything that we know and that we don't know is built in to the prices. Okay. That's how it works. And so, again, not to beat a dead horse, I hope that made some sense. I hope this was worth your time. Shoot me an email. Let me know if you like this stuff or not. And go enjoy your weekend. Don't worry about the market. It'll be fine. We go through these pullbacks all the time. They're not that big of a deal. And we'll be back at this Monday morning. And next week will be like this week. It'll be a little bit slow, but we'll continue on looking for opportunities. And if these technicals change, I've got a whole list of securities that I want to buy, but I can't buy them yet because we don't have the odds on our side yet. We always wait to have the odds on our side. Okay, that's a story. Talk to you soon. Have a wonderful weekend. Shoot me an email if you need me for anything. Bye-bye.